The markets were down. Everybody was down. So we all had to sit and take it. At least that's what many investors believe to be true. But we want you to know there is better news. A wise man once said, "Truth is simple. If it were complicated, everybody would understand it." In the next 6 minutes or so, I will try to share with you some of the truths we have discovered over the past 30 years. Once you can see the distinctions, it will help you to see the differences. Then you can make better decisions about your financial security. Let me show you what we mean by our title, Bull or Bear, We Don't Care. When many of us started to invest back in the good old days, 30 years ago or more, it was much like setting the temperature in your car. If you were fortunate enough to have a heater and air conditioning, it was necessary to turn the fan, turn the knob for cold or hot air, and adjust the airflow. On the way to church on Sunday mornings, I can recall my dad opening the window as my mom turned up the heat. No one was really comfortable. Today, thanks to innovation and technology, all passengers have to do is to set the temperature where they're seated in the car, and the car does all of the work. Now, that is a Bentley photographed on the right, and I don't have one either. But the point is, every passenger in modern cars can set the climate control and ride in complete personal comfort. Investors now have climate control capabilities too. As investors in the old days, we primarily bought mutual funds, selecting between cash, bonds, and stocks. Then we would rebalance portfolios looking backwards. Not much different than constantly selecting between cold and hot air and adjusting the airflow, attempting to get comfortable in our cars. Today, however, investors have more options to better diversify their holdings. While we continue to believe in modern portfolio theory and asset allocation, we adhere to the higher standard of capital preservation. We can see, for example, in 2008 and early 2009, the last time your net worth was cut in half, investments that did a better job of keeping principal intact employed all asset classes, in addition to cash, bond, stocks, like currencies, options, annuities, commodities, and real estate investment trusts. These additional asset classes help to keep investors' life savings intact. Investors are generally familiar with strategic asset allocation, which relies on mostly traditional asset classes of stocks, bonds, and cash in a preset static allocation that is periodically rebalanced over time. As you can see, that strategic portfolio construction worked very well for nearly a generation in the 1980s and 90s. In the strategic environment, the right mix of traditional asset classes were designed to meet the investor's objectives over time. If you have more aggressive objectives, you can adjust your allocation to hold more stocks than bonds. And to become more conservative, you can adjust your allocation to hold more bonds and cash. But the effectiveness of strategic asset allocation changed somewhat beginning in 2000, the start of the worst equity decline at the time since the early 1970s, and the first prolonged market drawdown many investors had ever experienced. You remember 2000 and 2002 because it was the first time your asset values were cut in half. With investments reduced by 50% 2 times in the last 10 years, we can understand why investors call 2000 to 2010 the dismal decade. Frustrated after a prolonged bear market, investors increasingly look beyond the traditional stock bond model to non-traditional asset classes such as the real estate investment trusts, commodities, currencies, high-yield bonds, etc., for greater diversification. In fact, large institutional investors like foundations, endowments, and pension plans had already embraced some degree of alternative investment complements to traditional assets. The top line in this chart includes some of those alternative type investments like real estate, commodities, and currencies, which as a group had positive returns during the extended bear market. During that period, from 2000 to 2002, broader diversification did help buffer the negative impact of the tech bubble bursting. So it makes sense that more investors turn to non-traditional asset classes to enhance their strategically allocated portfolios to improve their long-term performance potential. Then came the credit crisis of 2008. The credit crisis of 2008 was markedly different than the equity bear market of 2000 to 2002. But another 50% loss was the same reversal of fortune. Panic and fear impacted most asset classes in the same manner, as investors liquidated nearly everything. The exception was the safest, short-term, high-quality investments. Even well-diversified portfolios, those with non-traditional asset classes, lost significant value. It seemed like traditional strategic asset allocation wasn't working very well anymore during this period of time. Studies show that when markets are up and returns are positive, most investors are more risk tolerant. But when markets decline, investors tend to become more risk intolerant. That's a challenge for strategically allocated portfolios, since a shifting risk tolerance for investors is not consistent with the static allocation of strategic investing. Instead, it may be useful to employ a strategy that can be actively adjusted as the risk exposure changes in an investment portfolio through all market cycles. For example, the table on the right simply lists the quarterly performance of a traditionally balanced 60-40 domestic stock and bond portfolio and a short-term fixed income portfolio during the recent credit crisis. It would be beneficial to have a strategy that would dynamically move away from risky assets as markets trend downward and tactically shift to safer investments such as short-term fixed income investments, and then shift back again into the risky assets when markets trend upward. No one knows exactly when the next reversal of fortune will take place, but many believe it will happen again. As an old Boy Scout, we need to be prepared for the next downturn and learn more about the strategies discussed here. So please feel free to contact us by email, phone, or visit our website, www.ybpoor.com. Click on Contact and request information. You see, we look forward to helping you too. Put financial security strategies in place so that if around the next corner it's a bull or a bear, we don't care.